Well, good morning. Let's get going, shall we? And welcome to our presentation of NCC's results for 2018. So running order for this morning, I'm going to give you a couple of slides of overview. I'm then going to hand over to Brian for a bracing dip into the numbers, and then I'll pop up again to provide a bit of an update on our strategy, and then we'll take some Q&A at the end. So with no further ado, as an overview, our belief in the foundations of NCC as a platform for growth continue to be validated. And we've seen some good progress in the year, including continued double-digit growth on the top line, the reversal of the gross margin declines that you've seen over the last couple of years, and significant improvements, I'm pleased to say, in free cash flow, which is now converging further on the profit numbers. There are still legacy challenges that we have to confront. Anybody who thinks that we can shed all of those in the space of 6 to 12 months is probably being a little optimistic, and I'll talk about those a little later. But to ensure that we get on top of those challenges in a systematic and relentless way, we've launched our transformation program, Securing Growth Together. That was launched at the very end of the last financial year. And again, I'll be talking to you a little more about that. Now, before I just run through the numbers, you will have seen also this morning the announcement of the appointment of a new CFO. So you've all heard about the stepping down of Brian, and I'd just like to take this opportunity, please, on behalf of myself and also on behalf of the whole firm, to say thank you for everything that you've done and the support that you've given to me and everybody who works inside NCC. So thank you, Brian. And also, equally, as you can imagine, delighted to have Tim Kowalski joining us on the 23rd of July, bringing with him an absolute wealth of public company experience and also transformation experience. So on to the numbers. Over the past 12 months, we delivered revenue of 233 million, up 13.8% in our assurance division on an organic basis. That's the number we look at. And on a like-for-like basis, that's up 2.7% in our escrow division. Adjusted EBIT coming in just a touch ahead of where we thought it would at 31 million. And under that hood, we're seeing gross margin improvements of 5.3 percentage points in assurance and 4.5 percentage points in escrow. We're particularly pleased with the free cash flow improvement up to £20.4 million, and you're seeing there just the glimmerings of the work that we're doing on working capital and other cash management starting to come through. Operating cash conversion of 90%, which all, of course, conspires to bring the net debt down to just under 30 million. So in summary, sales momentum maintained, margin declines reversed, and cash generation is improving. And so for more detail on that story, I'll hand you over to Brian.
Thank you very much. What you have in front of you is the income statement for the year. I won't go into all of this in detail on this slide because actually most of the figures on here we do cover in a little bit more detail later on in the presentation. Just to draw out a couple of things though, this is presented just on continuing operations basis. So pretty much all the numbers you're going to see are excluding web performance software testing that were sold this year and also the domain services business which was sold last year. As Adam mentioned, revenue growth in the year was very good and gross margin recovered. Should emphasise the gross margin recovery this year was relatively simple in terms of how it was achieved. Basically, we kept our headcount flat while our revenue grew, which is almost the reverse of what had actually happened the year before when margins were contracting, when we'd actually allowed recruitment and staff cost to rise faster than revenue. So it wasn't particularly sophisticated, but it was effective. You'll see later on that if we're going to make more gains there, we need to get more into the detail of how that's actually going to be delivered. If you look on here, G&A costs and D&A costs, those have been flagged previously that we had committed costs in those areas since 2017, largely around people, but also some property costs. I'll cover adjusting items and tax a little bit later on, but what all this amounts to is the combination of growth, the improvement in gross margins, partly offset by some of those cost increases. You've got a 34% increase year on year in earnings per share. If we just go into a little bit more detail then in terms of, excuse me, revenue performance, the big blue bar on there, and it is big and it is blue, and I do want you to look at that first, that's the organic growth in our assurance business, £23.1 million year on year. Okay, so that was very effective. Adam's already referenced it, the continuing double-digit growth in our assurance business, which we've managed to stay on top of. If I then just explain some of the couple of the other technical things on this slide, I mentioned discontinued operations, web and software. That's that grey bar to the left, the minus 29.2, and the minus 8.6 sitting beside it. Again, we flagged up 12 months ago that we really weren't wanting to emphasize in the business reselling third-party products. That's us bringing that down to what I call a normalised level in the business. So it's a few £1 million a year. It will stay there. Clearly, if we've got big, important customers and they ask us to source stuff for them, we will, but it's not something that we're adding a lot of value to, and it's not something that we're putting our resources into. So it's now down to, as I say, what I call a normalised level. Other little things in there, there were some small FX changes, weakening of the US dollar by about 6%, strengthening the euro going the other way, around 3%. Acquisitions was the full year impact of 2 businesses we bought in the United States halfway through to 2017, so we've got a full year benefit of that in 2018. And then the last one on there, escrow. It's £2 million headline growth, but actually £1 million of that was, you'll remember last year with a revenue correction of £1 million. So the underlying growth in escrow, much more modest, it's around 2.7%. Then going over the page and doing a similar analysis around our adjusted operating profit or adjusted EBIT in the year. Again, the 2 big blue bars, focus on those first. The first £6 million increase in adjusted operating profit, that's coming from that big blue bar on the previous page, i.e. growth. So £6 million of operating profit increase coming from the organic growth in the business. The second thing is, and it's a bigger bar, the £10.8 million increase in profit coming from gross margin gains. If you take our 230 million of revenue and multiply it by a 4 or 5% margin gain, you can see that you actually get a very significant contribution to the bottom line. I wouldn't necessarily expect that bar to be that big going forward, though, as I mentioned, gross margin gains in future will be harder to get at. They are still there, but there's work to do to actually deliver those. Excuse me. G&A costs and D&A costs. I've mentioned a lot of that was pre-committed in previous years, whether it was new people, new facilities, new offices, etc. There is one-off thing in there you can see down at the bottom. As part of our strategic review, we looked at the number of products that we're selling, and these are our own products supported by capitalised development costs. We decided to withdraw from a number of those, and that's actually led to a 1.5 million charge in normal operating costs in the year that was inside that. So that's what gets you to the 31 million adjusted operating profit for the year, which I think Adam mentioned is a 22% year-on-year increase. If we just go over the page then, there's a little bit more detail on the assurance business. I won't say too much about revenue here because it's broken down further still on the next slide. But basically you've got 13.8% organic growth, which I think we'd all agree is a decent outcome for the sort of business that we are. Gross margin, I've already mentioned, grew 5.3 percentage points. And again, just to emphasise, it was through improved utilisation. Some people have asked if the restructuring, the transformation is complete. It's the opposite. We're still in the foothills of that. This was, as I say, delivered just through simple utilisation gains. Just to draw out on the overhead increases, some of those were genuine investments, particularly in the back end of the year. And Adam will talk a little bit more about it later when he talks about the transformation programme, but we have started to reinvest, if you like, some of those gains. So rather than just squeezing the lemon a bit tighter, we've actually started to put some money back into the business, and you'll hear more about that going on. Last one, just to explain, we've booked a provision in the year. We identified a loss-making contract in our Fox business. That contract was signed in 2014, so it was before we actually bought the business. And it was deliver something that had never been done before. So you can understand why you sign a contract to deliver something that hasn't been done before, and yes, you hit bumps in the road as you go along. And that's basically what's happened. We've identified it's going to take more effort. We are obviously honouring that contract, putting more cost, more of our people into it. The result is it's going to be loss-making over its life. We've booked a provision for £2.5 million, and £1.5 million of that was utilised in the current year. So just to draw that out. The second thing to draw out in there, and it's in the same bullet point, is, and this is why I'm saying, that there's still a lot of work to do. you'll see when we go over the page, the Fox business grew 17% in the year, but actually it didn't have any impact on our operating profit. So we got 17% growth, but didn't make any extra money. And that's partly because Fox, similar to other parts of NCC, we can deliver things inefficiently, so they need to be improved, systems, processes, etc. So again, I wouldn't want you to come away from this thinking all parts of NCC are firing on all cylinders. Clearly, there are different parts of the business at different stages of development, and there is still work to be done around there. But ultimately, if you look at the EBIT margin chart in the bottom left, you can see that there was a couple of years of decline, and the recovery has started. And just to emphasize, it has started, okay? Not finished or not nearly done. If I then just go over the page, this is one of the charts that, why I was being slightly conservative talking about the last slide. When you look across those growth rates, those are all excellent. So UK professional services, North American professional services, mid-teens growth. Fox in total is 17%. You can see our high assurance business line is recovering strongly, but it's recovering strongly from a low base. Again, the history of that service line is well known in Fox in terms of customer orders slowing down and only starting to pick up again at the start of this year. The one disappointment in there, I guess I would say, is our managed service business in the UK. It is something that we value and we want to grow. It actually went backwards by 1.5% in the year. But it is fair to say that business unit in particular saw a lot of management change. A lot of its senior sales guys are actually pulled out to work on the strategic review and some parts of implementing the target operating model. We've now put a new technology platform in there. And again, our goal is to return that part of the business to growth. And last but not least, Fort is a very small part of our business. But it's a really good example of how we can leverage different parts of NCC around the world. 25% of what our Danish business sells is delivered by someone else in NCC. That's very uncommon in NCC. Normally, our US business, they deliver most of their own work. Our UK business, they deliver most of what they sell. Our Fox business, they deliver most of what they sell. Fort is a good example of how the guys are actually reaching across territories and pulling in service delivery to support what they've sold. A little bit more detail on escrow. I did mention revenue growth of 2 million in the year was flattered by that prior year revenue correction. If you look at organic growth around 2.7%, that all really came from the UK. In the United States, on a reported business, revenue was actually down 5.1%, but if you exclude foreign exchange, it was flat. We have started on the back end of the year to start to put more resource and effort into the US escrow market. So we've actually relocated some experienced, qualified UK escrow people, both from a sales perspective and also a delivery perspective. And there are other changes which Adam will allude to later on, to try and kickstart what we do think is an exciting opportunity for the group. The US escrow market is big, and we would like to return that part of the business to growth. So undoubtedly, delivering a flat outcome in the US this year, we'd like to have done better, but that is something we're going to be focusing on. Then just look at individually significant items. Obviously, last year there was a significant amount of these, primarily dominated by goodwill write-offs in respect of Fox and the old Accumuli business. In the current year, I've already explained the loss-making contract in Fox, the 2.5 million provision that was booked, and that 1.5 of it has been utilised this year. Other key ones to draw out on here, restructuring costs. That was around the costs of completing the strategic review. And then when we implemented new organisational structures, there were various management changes and people changes that came out of that. So that's the costs in there. And then the last significant one on there in the current year, property costs. We have reviewed what property we have in the UK and how much we actually need. And we've identified 2 properties which today are actually now empty. One of them was empty for the whole year, and the other one was heavily underutilised for almost the whole year. We've now booked a provision against the onerous leases on those 2 properties. One of them was our entire office in Reading. And the second one was a unused half floor in our head office in Manchester. So that's what's in there. Those property cost or lease provisions in Reading, they run for another 3 years. In Manchester, they actually run for another 10 years, which is why it's a relatively large figure on there. Go over the page, some of the technical stuff. So around tax, an adjusted effective tax rate for the year, 22.1%. There is a benefit in there. It'll flow into next year more strongly, but you'll all be aware the US federal tax rate was cut from 35% to 21% on the 1st of January, so that's helped this year's tax rate. It's also fair to say, though, as well, we've actually done quite a lot of work, particularly through my finance director in the United States, on R&D tax credits where we hadn't actually claimed any. We have a large, it's $4 million with a small discount then for risk, R&D tax credit relating back for the last 5 or 6 years. That will turn into cash in the next 12 months. And then going forward, there's a separate figure that will support a lower effective tax rate going forward. I should emphasize, if you're looking at our effective tax rate from an adjusted EPS perspective, the benefit of that claim has been stripped out. If you included that claim, the effective tax rate would be closer to 17%. But it's a one-off, so we've stripped it out in calculating the effective tax rate. And our medium-term goal then to manage to an effective tax rate around 23%. Moving on to dividends, the board has decided to keep the dividend unchanged. So that's now second year in a row where there's been no change to the dividend. If you look at the chart on the bottom left, you can see dividend cover is recovering. You can also see that our earnings per share is recovering. However, we need to invest in our business going forward. Adam's already referenced the need to spend £3 or £4 million a year investing in the business for the next 2 years. The board's decided, therefore, that the best policy at this stage is to keep the dividend flat, but it will stay under review as we go forward. Moving to cash flow. The summary, and again, Adam encapsulated at the start, is that our cash flow is now starting to look more like our profit, which is a good thing. I think everyone would agree. Most of the improvements in cash generation this year came through the actual improvement in underlying performance, but also starting to do some improvements on working capital. I emphasize starting to do improvements in working capital. If you look at the second sub-bullet under working capital, current debt has improved by 7%. Sounds really good until I tell you that aged debt or overdue debt is still 40%. So 7%, great start. 40%, there's a lot to go at. And whether the right answer is 10% or 15%, you can see that there's quite a lot still to come out of that. We've referenced in the past accrued income that it can sometimes take us 6 months to bill a customer. We've cleared out almost all of our old accrued income. So whether it's at the 6 month, 5 month, 4 month, you're now into handfuls of hundreds of thousands of pounds. You can see the figure up there. We've cut that by 1.6 million. So we're moving the processes or accelerating the processes so cash is converted more quickly. I'll draw it out on there because it's quite a big change. The tax paid number has gone up so significantly, even though the effective tax rate has fallen. Basically, we had made a bunch of prepayments in 2016, which flattered then the 2017 number that we had to pay. That 2018 number is a more normalised number. So that's closer to what you'd expect for a cash tax going forward. Tangible capex in the year, 7.7 million. That did include the final payment on our Manchester office fit out. So if you're thinking about capex going forward, knock off 3 to 4 million from this year's figure. And that will be the sort of normalised run rate you'd be looking to get to of around 8 to 10 million pounds. Something just to draw out, Fox deferred consideration. Again, we've said before there was an arbitration going on that we were talking to the former owners of Fox about whether or not we'd actually make that final payment. We've decided that in the best interest of the business, focusing on the future, not distracting the current management team, none of whom were in place when we actually bought this business, we've decided to settle the arbitration and make that payment, which we did in full in the second week of June. If you're wondering if we were playing games with our banks here in terms of covenants or interest margins, etc., just so that you're aware, the Fox deferred consideration counted as debt anyway. So whether it was paid or unpaid didn't make any difference whatsoever to our banking covenants and the sort of interest rates that we pay. But it's good to draw a line under something else so that we can move on and focus on the future. So just before handing back to Adam, I think the basic message coming out of the financials is that the quality of earnings is improving. There's a closer match to cash. Cash generation is starting to improve. We have got good free cash generation, and it's a good place to start. And from a personal point of view, given that this is my last one, I think that's just how I'd like to sign off, saying it is a good place to start. You know, Adam will talk about building buildings on foundations, etc. The building hasn't been built. There is a lot to do, but it's a good place to start. And with that, I'll hand you back to Adam.
Thank you, Brian. Cheers. Great stuff. So. Right. I'm now going to take 10, probably 15, if I'm honest, minutes of your time just to give you an update on the strategy. So back in January, I gave you a couple of things. I gave you some reflections on the business, what I thought its strengths and weaknesses were. And I also said my intent was to build on the strategic review that had been done by Chris and Brian. It was not to sort of hit the reboot button again and put the firm through yet another review and reset. The key was to build on those foundations, which were all perfectly sensible, and make sure that we could drive progress. And so that's what we're going to do. Now, first of all, I'm just going to reflect on those foundations. Now, there's no point running a cyber business, and there's no point coming to a cyber talk either if you don't hear some stories. So the best way to convince you that we have great foundations in our offering suite, in our clients, and in our people is to tell you a few things that we do. So, on the left, when I think about our offerings, which are from the very top of the strategic level all the way down to the grittiest of software and hardware, here's a couple of examples. It's a privilege for us to have supported the recent acquisition of GitHub by Microsoft, for example, in their $7.5 billion acquisition. And I would venture there are very few organizations, firms or otherwise, that could assemble a team of over 30 cross-disciplinary people and throw it at a target of that sophistication and provide the output that was required in that kind of pressured environment. So, that's a real treat. When I look down at some of the more esoteric hardware offerings, again, I look at some of the talented people that we had, and being able to deliver and put ransomware on some of the most sophisticated cars that are out there in the market today is a really thought-provoking thing, and a great example of where we are looking at the next technology, looking at the next risk, educating our clients and helping them to fix those problems before they manifest. The client base itself is a testament to the value we can add. We have over 50% of the FTSE 350, we have the tech titans, we have the banking giants, and we have over 1,000 SMEs as our clients. And for me, it's all about clients, and it's all about the validation that they give to us. Everybody has talented people, so they say. And people told me we had talented people too. Last week, we were in Madrid. We brought 550 of our technical people together from across Europe and Asia Pac for NCCCon, which is our version of the industry conference, and frankly, better than any external conference could possibly be. 85 hours of original, research-led content delivered over 128 presentations, and oh my word, to sit there and listen to the breathtaking stuff that they do is astonishing. I'll give you one example. A couple of years ago, there was a bit of ransomware, the sort of stuff that locks you out of your computer unless you pay, right, called Petya. Won't tell you where it came from. And then something else appeared in an accounting firm in Ukraine, which everybody thought was Petya, but wasn't. In fact, it was a rather nasty piece of kit, very, very virulent indeed. And it acquired the handle, not Petya, as techies are inclined to give it. That then spread. It spread to a very large shipping company and caused massive pain and disruption and, of course, cost. It spread to a very large logistics firm. It's no shame on them, right? This was a very, very sophisticated piece of kit. So one client came to us and said, well, what would happen if that hit us? Now, clearly, we didn't really want to release NotPetya on them. So what we did, well, I say we, what a transatlantic team of really rather talented people did was reverse engineer that piece of code, defang it to render it harmless, upgrade it so that it would bypass the AV of the day, and then help that organization understand what its vulnerabilities would be, and perhaps in time the vulnerabilities of its supply chain would be when faced with that sort of threat. And I think you'll agree that is the kind of capability which NCC possesses, and it comes from our people. So there we are, working across sectors, across geographies, and across technologies, which gives us, again, a little bit of an advantage, because we can see something pop up in a sector or a geography and then prep the rest of the firm to support our clients everywhere else. And again, we've seen that. On June the 12th this year, we saw some chatter about a recently discovered vulnerability in a document reader, and then we saw it go live on July the 12th elsewhere, and we were already ready to help our clients. So look, lovely foundations, all the foundations we need to build a great firm in the future. And we're working in interesting, supportive markets. The connected environment continues to grow. I saw a statistic which suggested that there are 20 billion things connected to the internet, due to rise to 30 billion. Whatever the numbers are, they're large, they're going to increase. And as they do so, our reliance on that environment increases, whether it's us as individuals, as businesses, or society. But meanwhile, the threat grows. In 2016, 7,000 almost vulnerabilities were reported publicly. In 2017, it went up from 7,000 to almost 15,000. As we sit here today in July 2018, it is already almost 10,000. And so we can see that exponential increase of vulnerability is on the march. And regulation is doing its best to catch up. We've seen GDPR here. We've also seen the impact of the Chinese data protection legislation. We're seeing NIS coming in for infrastructure companies here. That is only going to increase. Regulation will increase, and so will the costs of compliance failure. And that is why, as we like to say, everyone needs a hacker. And happily, that's us. Now, of course, we're not the only people to recognize the excitement of this market. Cyber is a heavily invested space, and that brings two particular consequences. Number one, it brings price pressure as people pile into the market, selling in some cases what we like to call magical amulets, which will take the pain away from the clients. But it certainly creates a lot of noise. And secondly, the level of investment coming in is creating competition for a limited, or rather a finite, pool of talent, which is leading to wage inflation, two things that we've referenced before. Some of our challenges are not of the outside world's making. Over the previous 5 years, we saw revenue increase really quite significantly. We saw our margins decrease, and we saw our cash flow diverge quite significantly from adjusted EBIT. And those were all consequences of, various things, but in particular, a transactional way of operating and a desire to chase revenue, sometimes at all costs. And finally, NCC is built through 23 companies of acquisition, and therefore not all of those have been, not all of those have been integrated flawlessly. We have complicated systems which do hinder our people and make it harder for us to do the work that we like to do, and also, as management, have visibility of what we would like to see. So against that context, the challenge for us was to build on the strategic review of last year. And so we undertook an exercise of strategic alignment. We went around, we talked to people within NCC, and we crystallized what we felt the challenges of the recent past were. And of course, we did work to decide where it was that we wanted to take the firm in the future. And I'm not going to dwell on these, you've got them in front of you. But we want to move, for example, from an ethos of transactional selling, chasing revenue, to an area where we have deeper client relationships and helping them through their entire life cycle of issues. Now, in terms of a framework, we took the foundations that I've already talked to you about, and we set out where we're taking the firm. And I won't spend long on this, but in terms of a vision, here's ours. We're taking NCC to be the leading cybersecurity advisor globally, trusted to protect our customers' critical assets, sought after for our complete people-led, technology-enabled cybersecurity solutions that enable individuals, businesses, and society to thrive. And I love this last phrase. Whether it belongs in a vision statement, I'll let you decide. But frankly, it captures NCC. Our heart is in our space. This is what we do. And frankly, the people who work for us would be doing it anyway if they weren't doing it here. So why do people come to us? Because our heart is in our space. And I'm just going to take one more minute of your time to focus on a couple of these words so that they're more than just meaningless words. Leading. Leading because we do what we've always done. We look at the impact of the next technology, whether it's biometrics, whether it is automotive, planes, trains, whether it is machine learning, whether it is blockchain, and we understand the risk of it breaking. And we educate people and we help them fix it. We want to be sought after. We no longer want to be transactional. We want to become expert in the worlds of our clients, so we understand their business, we understand how they make money, and we can offer them more appropriate solutions and indeed become more sticky. People-led, always. People are our most important asset, but where we can automate and make their lives easier, we will. And finally, it is our job to allow people to thrive. Cybersecurity is our business. It shouldn't be yours and it shouldn't be your business's. Okay? So our mission is to help you take that pain away. So building on our foundations to get to that objective, how do we do it? Well, we've launched our transformation program, Securing Growth Together. They have 4 work streams, and I'll talk to those in a little bit more detail in a minute, but it became apparent to me in my first 100 days that the diagnostics that had been done in NCC were absolutely right, and the willingness and the appetite for change was there. But, surprise, we didn't necessarily have the people and resources in place and the governance structures in place to make sure that we would make relentless progress. And so that's what we've done, with the obvious aims in mind: rewarding careers, shareholder value, and client impact. Although, as we prefer to say, have fun, make money, do great things for clients. So a few more words on securing growth together. These are our core work streams. At the end of the day, it is all about capturing value and delivering value for clients. That is the most important thing for us. And to do that, we've got our win business stream and our deliver business stream. Win business, very much about improving the quality as well as the quantity of our revenue. So what are we doing? Well, first of all, we're putting in place, for example, one way of interacting with our clients, so that the 23 different organizations and the various parts of NCC spread across the globe can work together to capture larger pieces of work and add more value. We are bringing an increased sector focus, as I say, becoming expert in the world of the client as well as expert in our own world of cybersecurity. And behind that, deliver business, to generate one firm, one way, so that we can draw together resources from across the world, expert in whatever technologies or risks that are required to work together to solve our clients' issues. Now, if win and deliver are, what it's all about, then we have to gear the entire firm to support that. And support the business is what we're doing in that area. So we talk again about one firm, one way, having standardized ways of working, putting in place the necessary supportive, scalable structures. But let me say a word here. We want to maintain the feel of a boutique, which we have in so many parts of our business. We want to create the environment where quirky and interesting people who do this work will thrive. But we want to provide them with simple, scalable, supportive tools that allow them to get on, do their work, and give us the rigor that we require as a FTSE company. And that is going to require investment, which I'll talk to in a bit more time. Develop our people. Wrapping around all of this is the ability and the desire to attract, to find, to retain, to nurture, to retain the best people. We already have a fantastic technical training program which is able to take people of the right mindset up to a level within 6 months to 2 years. We're now matching that with also first-in-class commercial training skills, because much of our workforce recognizes it cannot interface with boards and cannot unlock the value that is there to be unlocked. So that's what we're doing. And on we go. Now, I'd like you to know that as well as that growth program, which is formally launched at the end of May, we're already underway, whether it's with training, whether it's with some of the changes, but also critically strengthening the leadership. So I've already expressed my delight with Tim joining us fairly shortly, 23rd of July. But also, we've moved now to bolster our leadership in other key areas. So Global Operations Director started on the 2nd of March to take all of those support functions and harness them in support of our frontline people. We appointed a new MD of Fox on the 1st of June. That is somebody actually who's been with us pretty much since the start of the calendar year in a different role, but is now engaged. It's Eric Plugmakers. He was originally a Foxer, as they call themselves, once upon a time, went away to work at KPN and other places and has come back, and we're delighted to have him in role. Group Sales and Marketing Director. It's astonishing that a group as interesting and as powerful as NCC had nobody curating and creating the narratives that we should tell ourselves and tell our clients. Happily, we now have that in place. And finally, our North American HR VP, a stellar individual coming from a background of GitHub, Facebook, and all the rest of it. All the challenges we have and all the opportunities we have are to do with people. So we're very pleased to have him in. A little bit more work to do, but the team now broadly in place. So that's the high level. Last two things. I'm going to tell you what it means for assurance. I'm going to tell you what it means for escrow specifically. I think the parts of the vision which are relevant to assurance are pretty straightforward to identify, and our goal here is to continue the double-digit growth that we've seen, to see steady improvement in margins, and further to improve the cash flows. And by way of priority, we want to increase our global reach through attracting and retaining talented people. We want to increase our recurring revenues. So, we have already a managed service business in the UK, part of the Execumuli. We have a managed service business in Fox in Holland. And as of the start of this year, we've launched a coordinated managed detection and response business, which we see as the next generation of MSSP, the managed service security provider. We want to increase margin and reduce cost of sale by deepening that client focus and increasing the dependence in both ways. And finally, we will maintain our leading technical edge by continuing to invest in research and understanding the impact of the next technology and the next regulation. Escrow. What a great business. Trusted to protect our customers' critical assets. So what we want to do here is return escrow to confident growth. We've said historically escrow will do GDP growth, and guess what? It's done GDP growth this year. So can it do better? Maybe there are structural issues out there that will fight us and prevent us, but I'll tell you what, we're going to give it a damn good go. Now, what are we going to do to make that happen? Number one, closer coordination with our assurance business. Yes, these are differing offerings and there are different propositions, but at the end of the day, NCC has, through its assurance and its escrow divisions, great sales teams and great client lists. Working together, we can cross-reference. I think there's something like, I won't tell you the number, but there's a number of FTSE 350 firms where escrow does more revenue than assurance. Well, what a great opportunity for the firm, and vice versa. We are going to make significant investment into the USA, which has been disappointing. It may well be that there are massive structural issues in the USA that we don't fully understand yet, but I can also point at several operational issues which just need to be fixed. And by improving response times, having better quality people, and growing a powerful North American escrow business, I believe that we will see growth. We, as Brian has referenced, are seeding our capability over there with experienced people from the UK, and we are, in fact, relocating the divisional head from the UK to the US as a signal of our intent. Strategic priorities: maintain our leading position in the UK, continue to develop adjacent solutions to our core, including in particular propositions that are relevant in the cloud as that becomes an increasing part and on-premise software becomes a decreasing part of our clients' IT portfolios. Build our scalable capability in the US, explore opportunities with assurance, and indeed to begin to grow our stable European operations. So pulling all that together, just as a summary for what you've heard on the strategy section, we've undertaken a process of strategic alignment which built on the work that was done last year. We are shaping the firm to focus on capturing and delivering value for clients. We will work more closely between the escrow and assurance divisions, and we are launching a coordinated global managed detection and response business. The Secure Growth Together program is underway, and it is the vehicle through which we will deliver improvements for and with NCC. And all this is going to take some investment. So we intend to invest around £3 to £4 million per year for the next couple of years. And where's that going? Well, we're investing around a couple of percentage points of margin, around £1 million in escrow. We do not think it's right just to take what that division is generating with no thought to the future. So we're going to invest that, we're going to invest it hard, and we're going to look for a good return out of there. We're investing it in transformation. We're investing it in our people. Okay, both in further technical development, both in terms of research, but also in terms of commercial and broader skills to unlock the value that we have. Upgrading systems and ways of working, yes, and also not there, a little expansion into Europe to make sure that the opportunities we have there and the steady state business that we have there can be nurtured and grown. So that concludes my strategic summary, and just by final slide, summary and outlook before we get to Q&A. Markets continue to grow and provide opportunity for continued double-digit growth in assurance, and our intent is to improve the margin and to grow EBIT by around 1 percentage point per year over the next couple of years. We will see dilution over the next couple of years, £3 to £4 million from our Securing Growth Together programme, and also in the investments we're making in escrow. Brian's already referenced that further GM gains are closely linked to progress in our transformation programme, and our goal is to improve our cash flows. And all of that brings us with an expectation to deliver continued growth in adjusted EBIT in line with the board's current expectations. Thank you very much. So, we'd be delighted to take any questions.
Is there a microphone, or
And here it comes.
you can just say your name and where you're from and hopefully get it right? Because someone got it wrong last year where they were from. But I won't name the individual who just pointed at me.
It'll be nice to
Enron
get this.
from Lincoln and from Jefferies. A couple of questions. One, you and in a sense Adam's predecessors had kind of warned at the beginning of the year or cautioned that you would be focused on transformation, not excluding clients, but perhaps focused on existing clients rather than going out and winning every last bit of revenue. And yet you've delivered, near mid-teens organic growth. Is this just because NCC is such a machine that the orders keep coming in? Is it a market thing? Because, if that's slow, 10% for the whole group sounds like a prudent target going forwards. And the second question, wouldn't want to let Brian leave with the thought that he'd got it all sorted out. Evidently you haven't on working capital, in the sense, as you said, you're part way through that. Accrued income's improved, but you still need to kind of work through debtors and so on. There's probably also a question about aged debt, that this isn't debt that you didn't think was going to get paid. I know you made some bad debt provisions, but, effectively it's a matter of process rather than risk. So...
No, lovely. Well, why don't I start with that and reluctantly hand over the working capital question to you afterwards. But in terms of growth, I would just say with NCC, everything's a trade-off. We are operating in a growing market, and therefore, there's no point doing a transformation for the sake of it. So if this were X-growth, we could absolutely do this transformation faster and more vigorously and all the rest of it. But there is growth out there to be captured, and that's what we want to do. We have many, many clients today. It isn't clear to me that actually we're capturing sufficient value out of all of them to make the interactions we have worthwhile for them or for us. So that's always under review. But I think, this is the thing. We want to grow at a managed pace. And that is something that we've managed to achieve over the course of the last 6 to 12 months. And we want to carry on doing that. Growth at a managed pace means we are looking to capture the revenue growth that is out there for us to have, but to maintain and increase the quality of that revenue growth. So we're absolutely not going to chase revenue at all costs. And as we get a better handle on which parts of our firm are profitable and unprofitable, I'm sure you'll see us diverting resources and attention appropriately.
Okay, and then on the working capital, yes, there is a lot to go at. Yes, you are spot on in saying rather than it being identified risks that we're concerned about, whether it's billing and collecting accrued income or collecting trade debtors, our actual exposures in those areas have been relatively low in the past. But I think, for thousands of years, people have told you, when things are going quite well, you should, protect yourself against the future. So, we've taken that opportunity. So we're not expecting significant write-offs in our bad debts or our accrued income, but it's a sensible, conservative approach to managing today and the future.
Hi, Tintin Stormont from Numis Securities. 2 questions. In terms of the revenue growth, from an outsider looking in, how do we know that or what metrics should we be looking at to know that the growth that you're achieving is more the strategic kind rather than the transactional kind? In terms of your own dashboard internally, how do you know that you are making progress rather than it's just the natural cadence of things and culturally it still hasn't changed? So that's the first one. Second one is more on just the numbers. In terms of provisions, do you think we're at the end of sort of making provisions for anything else in the future?
Okay. So, I'll say a few words about the revenue one and then again add on as you like. So I think from the outside world, hopefully what you'll see is continued revenue growth and the improvements in margin coming through. That's where it's ultimately going to go. Clearly on the inside, we're looking at all sorts of things. Well, how many clients do we have? How much revenue do we get per client? What is the balance of revenue coming from the first 10%, 20%, etc.? We also look at how many products or offerings from our offering suite we sell to each of our clients, and clearly we're looking to increase that number and also increase the average revenue that we're securing from our top clients.
And then on provisions, it would be silly to sit here and say, yes, it's all over, it's the end. But sitting where we are today, I've already referenced, trying to manage part of the future and what we've done around debt provisions, etc. Certain things will always move around. There's stuff up there because of foreign exchange rates on contingent consideration, etc. But actually, you've heard we're specifically investing 3 to 4 million a year in operating costs. I think some other companies would sit here and tell you we're going to treat all that as exceptional next year, and actually therefore that our operating costs will be flattered. So again, that's just a statement of intent with the way, not just that we're managing the business, but that we're actually managing the results and the presentation of those results.
Damit Javir from Peel Hunt. Adam talked about few cool deals, NotPetya and the GitHub M&A transaction. If you wanted to take, maybe not an example, even generically, what I want to understand is what is different about the way you arrange the teams, price those deals, and execute today compared to 2 years ago, if you could. The other question I had was, I know that you are starting to send the sales team on more training, better account management. One of the things from my time covering IT services businesses, one of the metrics they used to give was client penetration had a direct correlation to profitability, i.e. the more business you can do with the same client, your business was more profitable. Is it something you measure? You did mention about penetration rates regarding escrow versus assurance, but even within assurance, is it a kind of a focus for you?
Yeah, so I'm going to answer the last bit first and then sort of retreat, if that's okay. So I don't think we do measure that specifically, but I wouldn't preclude it, because I absolutely agree with it. The further you can penetrate into clients on average, it's a reflection of a deeper relationship, and you lower your cost of sales, which is exactly what we're looking to achieve, fundamentally. In terms of how we go about pricing our rather different services, I think there's a couple of things. One of them is going to sound rather woolly, but it's really rather important. We've actually gone out, we've talked to all of our teams and said it's not just about revenue. It's also about profit, and by the way, it's also about cash. And that may sound incredibly obvious, but it's come as a stunning revelation to certain teams. So number one, getting everybody thinking about it. Number two, putting in place specialist rate cards for certain services. For example, hardware. For example, our centre financial services proposition. Areas where we have true, world-class capability. Of course, we're not going to let that out the door without having anything else. So putting in place specialist rate cards, which makes it impossible, or certainly very hard, for people to sell it at commodity rates. Those are just a couple of things that we've done, for example.
Michael Goldsman here from Citigroup. Just two questions on the escrow business. Firstly, the additional 1 million that you're investing into escrow, do you mind giving us a bit more detail on what that investment is? Is it going into cloud solutions? What is it specifically? Secondly, you also talked about greater collaboration between escrow and the assurance business. Just out of interest, how often at one of your clients is it the same decision maker that makes the decision for both products?
Yeah, so again, I'm going to do those in reverse order, because then Brian can remind me of the first one. So I think it's very rare. And in fact, interestingly, in the strategic review that was done last year, we went out and said, is it important to you to purchase escrow and assurance from the same people? And the clients went, no. And that seems perfectly sensible to me. However, the conclusion that we drew, which was therefore we should never let these two divisions speak, is the wrong one. Okay, so from an NCC end of the telescope, both of these divisions have great sales teams and they have great client lists. So the question is, how can we exploit? So we do have some lovely examples of where we've been working away in assurance, and we've been able to also offer the client an escrow solution which has fit their needs. And the fact that we've only started doing this in the last 3 months, and we've already got those lovely case studies, tells me there's a lot of mileage in what we can do. So hopefully you've got that. No, clients don't necessarily come looking for it, but we've got assets that we can share and exploit. So then the first question was about where we're investing in escrow. Can I give you some more detail about that? Well, it's about further product development to look at what else. Over the last few years, the development and the sale of our software verification service alongside our core escrow offering has been very, very successful. and a great example of where NCC has been able to generate, through moderate investment, a new proposition which our sales teams can deliver into the same client base, and we'd like to do more of that. So some of it's going to go into product development, and in particular, continuing to look for those offerings we can provide in the cloud, which will mean that escrow is more and more enduring as an offering. Secondly, the US, which we've talked about. So we are putting infrastructure. Again, I referred earlier to straightforward operational challenges that need to be overcome. Some of them are just having the right leadership in place so that they can make on the ground rapid decisions, and that's how we win against our competitors more often than not in the US. So geographic expansion in the US, and then again in parts of Europe. So we have a few countries which today are yielding us a small handful of millions of euros, I think it is, on a fairly stable basis. It's lovely, but it isn't clear to me why we haven't set out to make more of that. So I know that somebody has recently flown over to look at the Swiss and German markets. You'll see us working more there. You'll see us bolster the office that we've got just outside Amsterdam and Amstelveen and similar. So those are the areas we're investing.
Just to add to that, on top of that, and it's symptomatic of escrow being underinvested for a number of years and just being milked as a cash cow. The client portal and the platform that all our escrow business is conducted on is more than 10 years old. Well, this year we decided, and it's a project that spanned both years, to spend £500,000 actually upgrading that to something that, in today's modern world, self-service clients would expect to be able to see, where they can see their entire portfolio of all the escrow products they've got, when they're due to be tested again, when they're due to be renewed, when they're due to be retired, etc. And say it's only £500,000, but it will be a significant transformation for that business to go from that very old clunky platform to something that's much more fit for purpose.
Thank you. Gautam Pillai from Goldman Sachs. Two questions from me. First, can I give some flavor on the shape of organic growth over the medium term? Many software companies in the enterprise space have seen cyclicality in their growth, but from a consultancy and services standpoint, how should we think about times of peak and trough demand? Second question is on headcount and attrition rates. Can you comment on how the attrition rates have trended, and is it within your internal targets? And a related one would be on utilization. You mentioned improved utilization rates this year. Is there more room to go? Thank you.
I'll kick off, and then I'll hand you over to the headcount stuff.
Sure.
That's all right. So simply, we are a people-based business. 85% of our business is assurance, and 85%, 90% of that is a people-based business, and therefore, I'd expect us to have a different profile to the cyclical peaks and troughs that we see in software. So I envy when they're in the zone. I envy their gross margins. I envy their ability to print money at sort of very little cost. But of course, we are a cyber services business, which brings its own advantages. Our ability to look at the next technology, to shape and to put in place the learnings, to understand what is coming along next, is considerably more agile and comes at a significantly lower cost than having to invest hard and get it right. Of course, it does nonetheless put a burden on us to continue to grow our headcount and to continue to generate that pool of people who can do the work. So I would expect our growth to be less cyclical, probably less explosive than some of the firms I'm thinking of in my own head, but hopefully steadier and more consistent. On the headcount side of life.
Okay. So attrition rates are effectively the same as what they were last year. And again, what we told you last year was just over 20% of the people who are there on the first day of the year have moved on by the end of the year. Again, some people may say 20% sounds like a scary number, but if you think that people just going through normal careers, you go somewhere, you get qualified, you get some qualification after your name, and you decide to move on. We do have that in our space, so we haven't seen our attrition rates actually get any worse. They haven't got any better, is the converse to that. I referenced earlier about this is a place to start. Yes, we'd like to have lower attrition, but it hasn't been getting any worse. There are hotspots around the world where, again, it is more challenging, whether it's because of the competition in the market or the alternatives that are on offer. In terms of the question about utilisation, is there more to go at? If you imagine that month to month, we may have variations in utilisation, but equally some months now our utilisation is towards what the guys would refer to as burst capacity, i.e. you're now slightly overworking people above the normal run rate. So you still have some months where that's not going on, but again, we spent 12 months not recruiting people. In the last 3-4 months we've started to add people in some service lines, in some territories, etc. So the simple answer is there isn't a simple thing to go at on utilisation that will lead to margin gains. It's now a slightly more complex challenge of making sure that if you've got someone who's unoccupied in Denmark or Holland or the United States and someone's got a demand in the UK, that we're flexible enough to be able to meet that. Just to add one more thing though about to Adam's comment about growth, it was on one of the slides about risk management and governance. So that's actually advising people on the big picture, how you're approaching cyber. And if you look at our Fox business in the past, it did almost none of that. And one of the things that the new ways of working have encouraged is there's now a guy who's actually responsible, he's the lead in the UK, for helping our overseas territories actually develop that service line, etc. So you'll start to see more parts of the group actually having commonality with other parts who are already leveraging certain strengths.
We've got 2 more here.
Yeah.
Hi, Ollie Knott, N+1 Singer. I just wanted to touch again on the sort of big special projects type area, and we've seen in the past that when some of these don't happen and don't come through, it does cause a problem for the group, and you've said that there have been 1 or 2 in this year. I was just wondering how that maybe compares this year to last year, and whether some of that gross margin improvement is due to having some more higher margin sort of one-off special projects within there, or whether it's all just utilisation gains.
Yeah, that's great. So I'll hand over to Brian in a second, but I'm going to say no. I think because big projects have occasionally featured at sessions like this, people have an impression that NCC is a business of big projects. It really isn't. In fact, it's quite the opposite. It's a business of lots and lots and lots of small projects. So I would very much steer you away. I recognise that having had the challenge with one project in particular and taking onerous provision does nothing except reinforce that perspective. But I'm going to do my damnedest to change that.
I think if you reference back 2 years ago when big projects were called out, I think the revenue associated with them was around 14-17 million pounds. The kind of projects we're talking about now won't get to 7 figures. So yes, they're good examples of cool stuff that we've done, but you're not talking about, someone does a big M&A deal and suddenly we've got a 6 million upside on profitability. It's nothing like that. You're talking about hundreds of thousands of pounds. They're nice sized projects. But it's not going back to that, one big project is the difference between hitting a number and not hitting a number.
I think we had a final one over here.
Hi there, George O'Connor from Stifel. What kind of contracts are you signing in the assurance business? Are these sort of projects with framework pricing, or is it more flexible pricing on an ongoing basis? And then secondly, how are you measuring client satisfaction? Is it through NPS rates or renewal rates? Is there any sort of KPI you can give us?
Sure. You do one, I'll do 2?
Yeah. So in terms of types of contracts, it is a whole range. There's some of the big clients up there. They don't want to be signing a contract every time they give you a piece of work. So there will be master services agreements, framework agreements. We do actually individually price each statement of work. It's in the appendix. Didn't want to bore everyone to death with IFRS 15, but the impact on us is 200,000 of revenue out of 233 million, and that's actually because our contracts tend to be individually priced statements of work with individual commercial terms, and for the really big guys who might give you 40 pieces of work a year or 50 pieces of work. So we're not locked into pricing or cost downs or the kind of thing you'd see in other industries that are a real commercial threat going forward. Obviously the one exception to that being the long-term development contract in Fox, where we had to make a provision. So clearly having those master services agreements, being a preferred supplier, means that you're already pre-qualified for individual pieces of work, which is a good place to be. But we're not carrying risk on pricing or cost erosion or margin erosion on big long-term contracts.
Yeah, that's helpful. Ironically, it cost us a lot more than £200,000 of effort to discover the impact of iOS 15. But so coming back to your point about client sat and how do we do it. So when we did the strategic review, before my arrival, there was a good piece done there on customer satisfaction, but we needed something which is more live. So we've just rebooted that. In fact, we've recently done a significant piece of customer insight work, which has given us a lot of NPS information, but I haven't even briefed that internally yet. So sorry. And we're going to roll that forward. And keep doing it that way.
Hi, it's Paul Morland here from Canaccord. A couple of things on the growth prospects, really. Fox Assurance grew at 26%. I know that was from a low base. And as has been discussed, it's quite hard to grow services businesses. Should we just look at that as better utilisation has actually driven that growth, or is something else going on there? And within that business, is that where the 2.5 million loss-making contract provision was as well? And now contracts are less than 1 million, I think you said. Mm-hmm. So we don't need to worry about that sort of thing happening again.
So that part of the business, the high assurance part of Fox, is the only place that's doing, if you like, big development research-driven contracts. The recovery in revenue there was, if you remember when we bought Fox, a number of key customers in the Netherlands were worried about foreign ownership and actually stopped placing orders with us. That started to recover at the start of the year. So that growth, if you like, is not about utilisation, it's about confidence rebuilding in the customer that they're happy to place orders with a key partner for themselves. Sorry, was there another?
Yeah, the first part of the question was about growing services, and should we be looking at high assurance and all the rest of it. So, look, just a word of context first, by the way. We do some great work there. We've got some really clever people doing some stunning work for important clients. So that's terrific and an important message to get across. But it's not just manpower. So that part of the business, which is not representative of NCC as a whole, if you scaled it up, does have more product sales and configuration of hardware and therefore pass-through costs than NCC on average.
Thank you. Can I ask another quick one about US Escrow? You seem to imply when you were talking about the growth, you said there was a growth opportunity there, but you seem to imply that you kind of needed to do a bit more work to understand what the opportunity was. Can you put is that right? And if so, can you put a timescale on where you might be more confident about the US opportunity in escrow?
In terms of the size of the opportunity, the number one player in the US market, who isn't us, has got the same amount of revenue as we have in the UK. We're a relatively small player in the US in absolute scale. We might be in the top 5 providers. So we do think there is a US market that is much bigger than the piece of the pie that we've got. So we're confident about the size of the opportunity. In terms of actually delivering it, when you're on the edges of being of critical mass or the right scale, that's one. You've got challenges, which is one of the reasons that we're deploying those experienced salespeople, because selling escrow is different from selling other services, but also delivery personnel in the US. So I'd say we're more confident today about the size of the opportunity, but we still have the work to do to actually capture it and to start growing into that.
Last one more quick one.
Last one, go on.
Last one is on the margin. 1% guidance per annum for the next 2 years. But given the big improvement in gross margin in the insurance business, I think 5.3 percentage points, presumably that accrued over the course of the year, so the run rate going into this year would imply you've already got sort of baked in a bit of operating margin improvement. And I accept that 1% improvement is after the 3 or 4 million extra you're investing in growth.
So the first thing to say is that margin improvement won't have been visible last year, but the first decision I took when I was the interim CEO was we're not hiring anybody. So that, if you like, effect started kicking in March last year. So there's a full quarter impact last year. And if you like, revenue growth has been continuous. So I don't think it's a simple extrapolation of saying that there must be a much higher run rate at the end of the year. You do have the cyclical thing. Quarter 4 is very busy for us. Quarter 3 is very quiet, and you've still got that challenge in there. So even if the big quarters were getting that much bigger, the quiet quarter I think is inevitably going to be quieter, so you're always going to suffer from pretty low levels actually of utilisation in that third quarter.
Lovely. Well, I think it just remains for me to say thank you for coming. Thanks for your attention. Appreciate it.
Thank you.